The MPC discussions have taken place at a crucial time in the ongoing global financial crisis, now entering its 5th year. Many predictions and warnings of a return to recession in the advanced economies abound. The IMF, releasing its latest assessment of the global economy, said that financial instability, exacerbated by poor policy making, had worsened considerably and threatened growth, while policy indecision has exacerbated uncertainty and added to financial strains, feeding back into the real economy. So how does the MPC view these developments? Since the previous meeting of the Monetary Policy Committee, the downside risks to the global domestic prospects have increased. Growth in some of the advanced economies has weakened against the backdrop of financial market turbulence, generated in large part by the unresolved European sovereign debt crisis. Although economic growth in emerging markets is expected to continue to outperform that of the advanced economies, these economies are unlikely to emerge unscathed from the challenging environment. Heightened risk aversion has resulted in increased volatility of capital flows globally and a flight from what are perceived to be more risky emerging market assets. These developments have impacted on the domestic capital and foreign exchange markets. Recent data have confirmed the fragile and uneven nature of the domestic economic recovery, and unfavorable forward-looking indicators are consistent with the downward revision of the bank's economic growth forecast. At the same time, a number of exogenous factors have continued to put upward pressure on domestic inflation. This combination of declining growth and rising inflation poses a challenge to monetary policy going forward and is a feature being experienced in a number of emerging markets. The year-on-year inflation rate as measured by the CPI, the Consumer Price Index, for all urban areas was unchanged at 5.3% in August 2011. The categories of food, housing and utilities, and transport together accounted for 3.7 percentage points of the August outcome. Although food price inflation moderated from 7.5% in July to 7.3% in August, further acceleration is expected in the coming months. Administered price inflation, excluding petrol, declined from 9.3% in July to 8.8% in August. Underlying inflation trends remain relatively well contained, with the CPI, excluding food, petrol and electricity, declining from 3.9% in July to 3.8% in August. Year-on-year producer price inflation followed a strong upward trend, increasing by 7.4% and 8.9% in June and July respectively. Price increases in the categories of mining, electricity and products of petroleum and coal remained the major contributors to the PPI outcome, but there were also significant contributions from chemical and other manufacturers. Food prices continued to trend higher. Agricultural prices increased by 5.1% and 6.2% in June and July respectively, while manufactured food prices increased at rates of 5.9% and 6.3% in these months. The inflation forecast of the bank is more or less unchanged since the previous meeting of the MPC. Inflation is still expected to breach marginally the upper end of the target range in the final quarter of 2011 and to peak in the first quarter of 2012 at around 6.2% before returning to within the target range in the second quarter. Inflation is then expected to decline gradually and to measure 5.5% in the final quarter of 2013. The bank's forecast of core inflation, which excludes food, petrol and electricity, shows a moderately rising trend, peaking at about 5.1% in the second and third quarters of 2013. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University, remain on average within the target range for the forecast period ending 2013. Inflation is expected to average 5.5% in 2011 and 5.9% in both 2012 and 2013. This represents a slight upward adjustment for all 3 years. While financial analysts and trade union officials expect inflation to remain within the target range over the forecast period, business executives expect average inflation to exceed moderately the upper end of the target range in the coming 2 years. Inflation expectations, as measured by the Reuters survey of financial analysts, also remain fairly stable at the upper end of the target range. According to the survey, inflation is expected to average 5.8% and 5.6% in 2012 and 2013, respectively. The growth performance in the advanced economies has remained weak. There is a general expectation of even weaker outcomes in the near term, although it is still unclear if the stalled state that many economies find themselves in will translate into a recession. The IMF, in its latest World Economic Outlook, has reduced its forecast for US growth by 1% in 2011 and by 0.9% in 2012 to 1.5% and 1.8% respectively. Euro area growth has been revised down to 1.6% and 1.1% in these 2 years. The risks are seen to be on the downside. This slowdown comes against the backdrop of a deterioration in the sovereign debt crisis in the euro area and the inability of the member countries to reach agreements on a credible and workable solution. Concerns have also spread to the European banking sector, particularly to those banks with exposures to peripheral Europe, resulting in ratings downgrades of a number of French and Italian banks. Growth in the United States is also being affected by continued weakness in the housing market, as well as political disagreements on the pace and nature of the fiscal consolidation. Emerging markets are still expected to experience faster growth than the advanced economies, but remain vulnerable to contagion effects from a possible significant slowdown or recession in the advanced economies. In line with the current two-speed global economy, inflation trends are higher in the emerging economies, driven mainly by food and energy prices. Over the past 2 years, the extraordinarily low interest rates environment in the advanced economies has resulted in significant capital flows to emerging markets, with consequences for their exchange rates and asset prices. However, the pattern of flows has not been smooth. During bouts of global risk aversion, there has been a tendency for these flows to reverse to so-called safe havens. Risk aversion associated with recent events in the US and Europe have resulted in a high degree of volatility of flows to emerging markets, including South Africa. Since the beginning of this year, non-residents have been net sellers of equities to the value of 16.9 billion rand and net buyers of bonds to the value of 44.3 billion. However, since the beginning of September, non-residents were net sellers of both bonds and equities, valued at 4.6 billion and 7.6 billion respectively. These recent outflows, together with increased risk aversion, have contributed to the high degree of volatility observed in the JSE All-Share Index, in domestic bond yields, and in the exchange rate of the rand. Since the previous meeting of the MPC, the rand has traded in a range against the US dollar of between 6.68 rand and 8.33 rand per US dollar, and has depreciated by 15.6% against the dollar, by 11% against the euro, and by 12.7% on a trade-weighted basis. Since the beginning of the year, the rand has depreciated by 18.6% against the US dollar. I should emphasize that what we are experiencing in the foreign exchange markets is not unique to South Africa, but is part of a more general global sell-off of emerging market assets and currencies. This is not a result of problems in the emerging markets, but because of higher risk aversion and because of the need for liquidity in the advanced economies, where borrowing conditions are becoming much tighter. The 15.6% depreciation of the rand against the dollar since the previous meeting of the MPC can be compared with some other emerging market currency movements over the same period. For instance, Brazil at 15.4%, Poland 13.9%, Mexico 13.5%, Hungary 12%, South Korea 8.5%, and Turkey and Chile at 7.7%, to name but a few. It's also important to bear in mind that given the high degree of volatility, these figures are changing all the time. The depreciation of the rand poses a potential upside risk to the inflation outlook. However, the degree of this risk will depend on the extent and persistence of the depreciation trend, which in turn will be influenced by the duration and intensity of global risk aversion. The rand tends to be more sensitive to changes in global risk perceptions than most of its emerging market peers. At this stage, the MPC still considers the upside risk to the inflation outlook from this source to be relatively moderate but rising. Domestic economic growth remains disappointing, with a negative output gap widening to around 3% in the second quarter of 2011 and gross domestic product growing by 1.3%, following the 4.5% increase recorded in the first quarter. Both the primary and secondary sectors contracted in the second quarter, while real value added by the tertiary sector increased only marginally. Widespread industrial action, which continued into the third quarter, contributed to the subdued outcome and is expected to weigh negatively on third quarter prospects as well. Recent high-frequency indicators are also not very favorable. Mining production contracted on a year-on-year rate of 5.1% in July and by 4.3% on a month-on-month basis. Manufacturing output declined at a month-on-month and year-on-year rate of 6% in July, confirming the sharp decline to 44.2 index points observed in the Kagiso BER Purchasing Managers Index in July. Despite a modest recovery in August to 46.7 index points, the PMI remained below the neutral 50 level, pointing to a further possible contraction in the sector. The construction sector also remains subdued, with both the FNB Building Confidence Index and the FNB Civil Construction Index remaining at very low levels, while there was a further decline in the number of building plans passed in the third quarter. Overall business confidence, as reflected in the RMB BER Business Confidence Index, has declined for 2 consecutive quarters, and at 39 index points is well below the neutral level of 50. The bank has lowered its forecast for average growth in 2011 to 3.2%, down from 3.7%, while the forecast for 2012 has been reduced from 3.9% to 3.6%. The forecast for 2013 remains unchanged at 4.4%. The lower forecast is a result of the lower-than-expected outcome in the second quarter, as well as a downward adjustment to the global growth assumption. The risks to this outlook are seen to be on the downside. The lower growth trajectory does not bode well for employment creation, which has been relatively muted. According to Stats South Africa, employment in the formal non-agricultural business sector increased by 0.1%, or 5,701 people in the second quarter of 2011. The outcome, however, was negatively affected by the decline in public sector employment associated with the termination of contracts of temporary employees who were hired for the municipal elections. Consistent with the moderation in domestic production, growth in real gross domestic expenditure also declined from an annualized growth rate of 7.9% in the first quarter of 2011 to 1.3% in the second quarter. A positive development was the further acceleration of the growth of real gross fixed capital formation, albeit off a low base, from an annualized rate of 2.7% in the first quarter to 4% in the second quarter. Nevertheless, the ratio of gross fixed capital formation to GDP at 18.9% is still well below the peak of 24.6% measured in the fourth quarter of 2008. Consumption expenditure by households has to date been the main driver of growth. However, in the second quarter of 2011, growth in consumption expenditure moderated to an annualized rate of 3.8%, compared with an increase of 5.2% in the first quarter. Real retail sales increased at a year-on-year rate of 2.8% in July, but declined by 0.7% in the 3 months to July compared with the previous 3 months. Growth in motor vehicle sales, while still positive, has also declined. Consumption patterns may have been distorted somewhat by the high base effects arising from the 2010 World Cup, and a clearer picture should emerge in August. The RMB BER Consumer Confidence Index has declined for 2 consecutive quarters, underlying the fragility of the outlook. Consumption expenditure is expected to remain constrained to some extent by low rates of credit extension and continued debt deleveraging by households. The ratio of household debt to disposable income declined further to 75.9% in the second quarter of 2011, from a peak of 82% in the first 2 quarters of 2008. 12-month growth in total loans and advances extended by banks to the private sector has fluctuated around 6% in the 3 months to July. Mortgage advances, which is the largest category of credit, grew at a year-on-year rate of 2.9%, consistent with the slow pace of recovery in the domestic property market. The main driver of growth in credit extension was the category of other loans and advances, in particular general loans, which reflect primarily corporate sector borrowing. This category grew by almost 15% in the year to end of July. Nominal wage settlements have continued to moderate somewhat and have been lower than many of the highly publicized initial demands. Nevertheless, wage increases have been well above the upper end of the inflation target range. The main upside risks to the inflation forecast continue to emanate from administered prices and exogenous factors. Since the previous meeting of the MPC, the price of Brent crude oil has fluctuated in a range of around $104 a barrel to $118 per barrel. The outlook for the oil price will be determined in part by global growth developments and in particular by the extent to which China is affected by the slowdown. The recent depreciation of the rand against the US dollar is likely to contribute to a further increase in the domestic petrol price in October. Food prices are also expected to maintain their upward momentum for some time. The major global food price indices have remained relatively stable but at elevated levels during the past few months. However, global wheat and maize prices have increased markedly and have impacted on the domestic prices of these commodities. These increases have been compounded by the weaker exchange rate of the rand. The price of white maize, for example, has increased by over 70% during the past year, but futures prices reflect some expected moderation in the medium term. The MPC remains of the view that the underlying inflation pressures are mainly of a cost-push nature, and at this stage there is no evidence of significant second-round effects from these increases. Although the inflation trend remains on an upward trajectory, both headline and core inflation forecasts appear to be consistent with the continued attainment of the inflation target over time. Demand-side pressures remain subdued and are expected to be constrained in the short to medium term. Inflation expectations also appear to be relatively well anchored. However, there have been some changes in the MPC's assessment of the risks to the inflation outlook. The recent volatility in the rand exchange rate has imparted a degree of upside risk to the inflation forecast. Although the rand may not return to the elevated levels reached in the earlier part of 2011, the MPC considers some of the recent volatility to be of a short-term nature, influenced by the vagaries of global risk aversion. Downside risks are seen to come from the heightened risks to global growth and its consequences for the domestic economy. The overall risks to the inflation outlook are assessed to be delicately balanced. The MPC will continue to assess the changing risk profile of the inflation outlook and monitor closely those factors that could push inflation outside the target on a sustained basis. In the light of all of the above, the MPC has decided to keep the repo rate unchanged at 5.5% per annum for the time being. The MPC is, however, concerned at the potential impact of the current global turmoil on domestic economic prospects and stands ready to act appropriately should the need arise. Thank you. I'm happy to take any questions, and if I could ask you just to identify yourself, your name, and which media you work with, and we can proceed from there. Miriam?
Thank you, Governor. Miriam Issa from Business Day. In your statement, you alluded to the risk to the inflation outlook from the volatility of the rand, but the outlook you presented in the statement is for inflation is little changed from last time. How much, if any, of the rand's depreciation have you factored into your inflation forecast?
Well, the question that I think you need to bear in mind in terms of the rand volatility is that this is, while there has been a somewhat of a depreciation, this is a very current event, and I think it would be very difficult to assess how long and at what level that is sustained. I think it's very important for us for all countries, it's not just South Africa, is to try to see through the current noise and try and see beyond that. And that's very difficult if you look at the discussions taking place right now. So we are indicating our concern, but we are not looking at saying that obviously we do different scenarios and that we standardly do. But this is something that we will watch very closely and then look at and see to what degree this is sustained or a short period or how prolonged and at what levels. at this point in time, it's very difficult to say, as I said in the statement, that the depreciation of the currency is changing all the time, and it's very, very volatile.
Good afternoon, Governor. Nompimelo Losizipo from Summit TV. Just wanted to ask, given all the difficulties, in the event that the growth story gets worse and inflation gets worse, what then becomes the central bank's priority? Growth or inflation? So in other words, what I'm asking is that even if we see inflation rise, would you consider an interest rate cut?
I think that's something to look at the future. I think the point you're making is one that concerns many emerging markets, that emerging markets are seeing rising inflation and slower growth, and obviously are monitoring that very closely. A lot of that depends on what is happening in the Eurozone in particular, and in the confidence around the outlook and resolution to the problems both in the US and in the Eurozone. So it would be inappropriate for me to say to you which one would we favor as one or the other. You actually have to take everything into account when we take our decision. But the point you're making about that combination is something that is certainly concerning many emerging markets today. Yes, sir.
Franz Wild from Bloomberg. Governor, was the notion of a rate cut tabled in the MPC meeting, and was there anyone who voted in favor of a cut?
Just to remind you that we don't vote, we discuss. If it's pushed to a vote, that would happen, but we don't vote at this point in time. Yes, certainly, it would be wholly inappropriate for us not to have discussed a rate cut. It was a considerable part of the meeting and of our discussions. In terms of the cut for now, of discussion of no cut for now, that was unanimous, but certainly there were at least one person who felt that quite strongly that a rate cut should occur now and it should be on the table. And certainly in the end it was agreed that not at this moment, but it was certainly part of our discussions, a significant part of our discussions at the back.
Sorry, Ed Stoddard with Reuters. Governor, I was just wondering, what is your biggest concern on the growth front? I mean, what's the MPC's biggest concern on the economic growth front? Thanks.
I'm not quite sure what you mean as to where is it growing or at what rate it's growing. Or
no, I'm wondering, what do you think is the biggest risk to growth at the moment, if I can ask?
The biggest risk to growth?
Sorry, yeah, thanks.
I think that certainly the biggest risk to growth for emerging markets is the fact that you know, the idea originally you've got a two-speed recovery and emerging markets are doing well. What's absolutely clear right now is that there isn't a decoupling, and that, in my view, that in terms of emerging markets, what happens in the advanced economies is going to be critical for growth for all of us. So the real issue for me would be how quickly a resolution is found to what is an ever-increasing problem, both in the Eurozone, which, as you've seen with the downgrading now of a number of banks and the tightening of the markets in relation to the banking sector, as well as the inability to pass a budget in the United States. Therefore, if you look at the reaction at this point in time to what the Fed has said and what is happening in Europe, is a question of growth and the ability to have confidence that there's growth. The real issue here is confidence that there can be decisive leadership and resolution found. So what is happening in the advanced economies is absolutely crucial. France?
Governor, to what extent will the weakening rand affect the central bank's ability to build up foreign reserves?
Well, we've always had the approach that we do not target a level of reserves, and we continue to accumulate reserves as and when it is possible. So we have that as a policy, but it may obviously affect the pace at which that can be done at this point in time. Helmut? Just lift that up. Yeah, that's it.
Governor, Helmut Preuss from New Age. As part of your discussions, were you considering the discontinuing the 5-cent coin, which doesn't seem to have any value anymore?
That is something that's not really a monetary policy decision. Obviously, this is something we're very aware of and something that we are considering, but as the executive of the bank, not as the monetary policy. And in the end, this is a cabinet decision, not ours, but we will be, we are reviewing the situation and I'll make a recommendation in due course. I don't know if anyone wants to add anything to any of the questions so far. Miriam?
On the subject of reserves, Nigeria has recently said it's going to make the Chinese yuan part of its reserves. Given that China is South Africa's main single country trade partner, is there no case for us also to have the Chinese currency in our reserves?
I think that has been answered a number of times in relation to the questions about reserves, is that we have a mix. We do look at what is appropriate at this point in time. Obviously, reserve currency is and safe currency is a very big debate. And we review on a regular basis. So we are aware of what Nigeria has done. It's not only Nigeria. There are a number of other countries. I think it's Austria. I think one of the Nordic countries. There's quite a few countries that are now having the yuan as, I think it's the Philippines as well, as part of their reserve currency. But it is something that we regularly review and take a view on. So it is obviously influenced in terms of the African continent, of the role of China on the continent. Bear in mind, of course, that it is linked to the dollar. Yes, sir.
Governor, what do you make of the
Sorry,
Fed?
just give me your name again.
Sorry, Tepo Mwai from SABC News. What do you make of the Fed's decision to keep lower interest rates environment till 2012, I believe? Given
2013,
that,
actually.
2013, yeah. Given that the sub position is that you look at these issues on an ongoing basis.
It's really, I don't think it's appropriate for me to comment in the detail because each country has to look at what its particular conditions are. Keeping interest rates low till 2013, as I said recently, is to me a greater reflection of the state of the United States economy than the issue around interest rate per se and what its levels are. Every country is taking a different view at this point in time. We have very different issues and problems from the United States. And far be it from me to second-guess a very competent and clearly vigorous and contended position of the rate-setting body for the Fed. At the back.
Governor, a question via the webcast. What are the implications of the current situation of the rand for the exchange rate pass-through and inflation?
Thanks. I'm going to ask Brian if he would deal with that one. I just need a sip of water.
I think as we indicated in the statement, that the degree to which there is pass-through from the exchange rate change to inflation will depend a lot on how quickly the rand moves, how long that movement or how long that deviation is sustained. It's a very different story if you have a very sharp depreciation that comes back in the short term to one where you have a sharp depreciation and then it stays at very much weaker levels. So as we indicated in the statement, we believe that a lot of, not necessarily all of the weakening is a result of global risk aversion. So to some extent, to the extent that that is short term, we expect the rand to retrace some of its movements over the short term. However, it's very uncertain, so we simply don't know. So from the point of view of the feed through to inflation, at this point in time, all we can say is that there is an upside risk to that. There is more risk than there was previously when the rand was relatively stable. But a lot is going to depend on the extent and duration of that, of the volatility and how far that volatility goes. And that in turn will be determined by how volatile the risk aversion is that we are currently seeing. I think, sorry, if I could also mention a lot will also depend, the overall impact on inflation will also depend on what is happening to other factors as well. To the extent that this weakness is reflecting, as it did in 2008, for example, a very strong slowdown in the global economy, we could then expect to see declines in other commodity prices, for example, the oil price, which then would have an offsetting effect on any depreciation. So we can't, obviously we can in our models consider the exchange rate on its own, but in reality it's depreciating alongside a whole lot of other developments that could have offsetting effects.
Helmer?
Thank you, Governor. Could you tell us when the trade-weighted rand will be rebased and reweighted?
Rashad, do you have anything on that? Is Dalian here? I don't think there's any plans at the moment for that. I'm not aware that we've got any plans for that at the moment. Non-Polana?
Governor, I no way seek for sensationalist type answers, but I just wanted to refer to the answer that you gave earlier about growth and the developed world. Given that you don't see that there's a decoupling, are you saying that if there is indeed a double dip recession, we too will also go into recession?
No, I'm not saying that. I am saying, though, and you see, let's just talk about the recession question itself. I think that there tends to be, in my personal view, too much focus on whether we're going into a recession. The reality is that even at the levels of growth now, you've got huge problems. A recession will seriously exacerbate it. But it's not as if only when you go into a recession will you have problems. There are very, very big problems right now. And that is the cause of a lot of this, this uncertainty and the volatility and the risk aversion, because the markets and people, ordinary people, don't see how this is going to be concluded in the advanced economies. What we are saying is that in this circumstance, even as it stands, and should it deteriorate, no one, by what I'm saying is that no one will be unaffected. It does not mean that we will go into recession. What it means is that if you are looking at it, so the rand is weaker, existing exporters will benefit from a weaker rand at this point in time. You would want some rand stability before new exporters come into the market. So there is a benefit to existing exporters. But if you are not growing, if there isn't a market to go to, then it's got an impact on you. So the challenge for us, as well as other emerging markets, is what do we do in those circumstances? Are there alternatives? It's a very interesting question for us as a country that, Stefans, you'll help me if I'm wrong, but my understanding of it is that our exports to the African continent are virtually the same as our exports to the euro area. Can you just elaborate on that a little bit?
Yes, Governor. In value terms, we have seen that over the past year and a half, the value of our exports of manufactured goods to the African continent is more or less the same as to Europe.
And therefore, in response to that, the African continent is expected to grow at about 5.5%. Obviously, it would also be affected by what happens, but at this point in time, the expected growth for the continent as a whole is about 5.5% for this year, as well as some of our neighboring countries going beyond that. Zambia, Mozambique, Angola are growing at 7% plus. So the question that South Africa faces as a country is, what are your choices? What are your options? Can you, if you like, look at alternatives that would help not only in the immediate but for the future as to where you can get growth and what kind of growth? So it certainly should not be read that I'm saying we're going into a recession at all. I'm saying that we cannot be unaffected by it. But it also, the extent of that depends on what we do, because we have, as you've seen, and a big effort that has been made by governments over the recent period to look at alternatives, building the ties with the BRICS, the economic ties and so on, very important part of that. So we're not a passive recipient. We also need to be an active player. Miriam?
Going back to the discussion of a rate cut, what was it that made the MPC decide not to go ahead with this step? Was there any, what would it take for the MPC to go ahead with this step?
We're going to have to see what happens in the future to go ahead with the step. I think I said at the outset, there's an enormous amount of noise taking place. I would defy anybody to be able to give you a clear picture that there would be common agreement on. Everyone will have their own view. But to have a common agreement of what exactly is happening now and what, don't forget, monetary policy has to be forward-looking, not just of the immediate. So it's very important for us to look through what is happening now, try to see beyond that, as difficult as that may be. And what we have said, and we said it very clearly, is that the MPC is concerned at the potential impact of the current global turmoil on the domestic economic prospects. And we stand ready to act appropriately should the need arise. But the current immediacy of what is going on needs to have a little bit of time to see what it actually means. What is permanent, what is longer term, what is shorter term, and what resolutions you may find or not. The reality, I think, if you look at the reaction to the Bernanke speech, is that people are looking for a one-line or a one-word answer. Oh, we can resolve it by the problems of doing A. The problems in the US, in the advanced economies, you've got a synchronized downturn between the United States, Europe, UK, and Japan. And that is hugely difficult to counter as to then where does growth come from and what you do. So very challenging times indeed without simple answers at all, very deep problems. And therefore, it's important at this point in time to be very steady in the way you think and what you see and analyze very carefully. There's a hand at the back there.
We have a question via the webcast again. Given the current household to disposable income ratio and the fact that there has been a slight improvement, how much weight does the MPC put to that in terms of stimulating consumer consumption to stimulate the growth?
Well, first of all, I actually think that it's important that we look at that decline, because I think it is quite marked in relation to where we were. So in my view, a very positive, longer-term question. I think that what you're seeing now is that households are still looking at their balance sheets and trying to improve their circumstances. I don't think that, if you look at it, what has happened with the current interest rates is that the servicing of that debt has been made easier. So that is something that's extremely important. I still think there's some way to go. And obviously the household debt to GDP ratio is important. We need to also look inside that a little bit and see what people are buying. Because part of it is, if you look at the low the low extension of mortgages and the slow take-up of that, it's obviously something that if a lot of the mortgages were going into debt, that's into household debt, it's a very different story than if it's current consumption. So these are the things we would look at in some detail and take note of it. But at this point in time, I think there's still work to be done in that regard. I don't know if anyone would like to add. Helma?
Governor, apart from interest rates, what else does the monetary policy look at in terms of policy options?
We obviously review the different policy options all the time, in the sense that interest rates is your main policy option. But what's clear from discussions that are taking place is that you need a tool of macroprudential, a toolbox of macroprudential options. To give you an example, a lot of countries, China, India, for example, use their reserve requirement. They're doing that because of the extent to which people are using credit and the level of credit extension. Our credit extension is very low at this point in time. So, yes, it is a monetary policy tool that you can use when appropriate, but in our judgment, it would not be appropriate at this point in time, given the levels of credit extension. So we do look at other tools, but not necessarily in the Monetary Policy Committee meeting only. We also look at it in our Financial Stability Committee, and we look at them ongoing to see what other countries are doing and what their approaches are to the different tools. And again, you know, part of that is how applicable to your own circumstances. Some of the things that Turkey is doing, Brazil is doing, we watch quite carefully, but we don't think they're necessarily applicable at this point in time. France.
Governor, would you agree that the rand at its current levels would actually boost the economy, you know, by promoting manufacturers and exporters? I do appreciate that you've already said that it might only be a temporary weakening, but, you know, if it were to stay at this level.
I think that's a big if. what we've said all the time is we do not target a range or an exchange rate that we set. It has moved. How long it will stay there? I think it will, as I said earlier, it will benefit those who are manufacturers with current exports because they will then be able to earn more. But unless there is some stability and some sense of where that rand will stay and the volatility around the rand, and I gave you some indication of what's happening not only with ourselves but other emerging markets, I think it is more difficult for exporters to go into the markets because they've got to take a longer view. So like everything else, it could be positive at that level, but we do not take actions or set a level or to keep it at a level. And then it depends on its stability about what it will do for the manufacturing sector and other sectors. Again, you've got to take the other side of it. Is there a market? And where that market is. So it's a mix of factors. It's not just, oh, if it was at this level, would it help? Hypothetically, if it was at this level for a long period of time, obviously it would have that attraction to exporters. But I don't think one can look at this and say, on the assumption that. I think it needs to be looked at as to say, how stable is this currency? Because volatility is hugely important in those kinds of decisions as well. At the back.
Governor, last question via the webcast from Desmond. Is there any chance the inflation target will be changed to target core inflation as opposed to headline inflation?
Can I ask my colleagues who are engaged on these, just bear in mind that in terms of the inflation targeting environment and what is set, this is a policy decision of government. They set the frame, so for instance the range of what it is and what it comprises is set by government. Our job is to then have the operational independence to meet that. But obviously there are discussions between ourselves in that regard. I'm sure in the past when you were setting the inflation target there was quite a lot of discussion about why core, why not core, and why more generally. I don't know if you'd like to comment. So this is many years ago when this was looked at.
If I remember correctly, but I think the general arguments the arguments for and against targeting core, the argument in favour of targeting core is that generally those are the components of inflation that monetary policy has got more direct impact over. But against that is the argument that if you are targeting something that is not easily observable and that is not really relevant to wage and price setting decisions. So, for example, if you ask trade unions to set wages on the basis of core inflation, they're going to say, well, how can you take food out of the component if we have to eat? So it's not a straightforward issue. There are some countries that do target core, some explicitly target core, some implicitly target core. For example, in Canada, they would implicitly they would focus on they would target headline inflation, but operationalize on their core inflation. So from a policy point of view, they would make the decision on core inflation. Governor, if I could just add something else to the previous question on the exchange rate and the impact on the manufacturing sector. I think the other important issue to bear in mind as to whether the depreciation will benefit exporters will, of course, be determined by the extent to which that depreciation does result in higher inflation. If that higher inflation then also results in higher wages and a further wage and price spiral, then any advantages, as we know, of the depreciation will be lost. So for there to be some benefit to the manufacturing sector, it has to be a real depreciation rather than simply being offset by higher wages and prices.
And perhaps just on the question about core and headline, I mean, we also need to talk about credibility, and that's why when we give you the information, as we have just done, we'll tell you what we see when we're looking at core and when you're excluding petrol, oil, food, but electricity. So the question for us is that if you exclude that, how do you have ordinary people who are affected by inflation relating to what you're trying to do? And don't forget, inflation targeting in the end is a tool to influence expectations. That's really what it is. So that if it doesn't have the credibility or the relevance to what people are experiencing, then your ability to use that tool is diminished.
Governor, in terms of assessing the effectiveness of that tool, is it possible in the next monetary policy review to have a special box just looking at how accurate the core inflation forecast was and what the sort of error was over the past few years? Thanks.
I'm sure that's possible. But
I guess that's part of a general review of our models and what we think the the robustness of our forecasting was over a series of years. So I think that would apply for CPI as a whole as it would apply for core.
Yeah, that's not about core. That's just about a review of what was there and what was the outcomes.
Core previously wasn't published by the Reserve Bank, so this is the first time that I've seen it, and therefore, if possible, could we just have a special box in the monetary policy review in November?
What I would say is that let us look at the issue of the review and what it is. We've been speaking about it anyway, so we can certainly see whether it is appropriate for the next one or thereafter. It certainly should be done. So in principle, yes, but I'm not making a commitment to the next one because they will have already looked at what needs to be there. Okay. Any other questions? Anyone who'd like to add a comment from the bank? Thank you all very much. We certainly live in interesting times, and we'll see you at the next Monetary Policy Committee press conference. Thank you all very much indeed.